Okay, guys, well, we're going to start the webinar. First of all, thank you for coming to the webinar tonight. I know you guys has a busy schedule, so do appreciate spending time this evening. That means a lot to us. Before getting to the contents, there's a few housekeepings and disclaimers. So this is a webinar style, so all the attendees cannot speak. So if you have any questions, please write down in the chat box so we can address and answer all these questions at the end of the presentations. And the disclaimers, this is a 506B offering. So this information is confidential. Please keep it within this group. Also, all the informations and numbers in the presentation, we believe it's accurate. However, this is a reference only. So if you, please do your own due diligence when you make investment decisions. And if needed, please consult your tax, financial, or legal advisor to make investment decisions. And I want to introduce GP Group before getting to the contents. I'm very honored and excited to have all these talented individuals as a team. As a team, we have extensive knowledge and experience in the commercial real estate, and I'm very excited about that. And starting from me, my name is Yoshi Asano. I'm the lead GP, so I'll be the manager and operator of this project. I'm based in Dallas and have more than 1,000 units asset under management and be involved more than 200 million in transactions and commercial real estate investments. Of course, I'm a full-time in the multifamily investment operations, and I'm 100% committed to this business. John and Meryl. Meryl, you want to introduce your team?
Good evening, everybody. Meryl Callister here. I think John will get on as well. I'll spend 2 seconds. I'm a corporate real estate SEC lawyer. We've represented about 6 billion of these transactions over the last 15 years. I've known Yoshi for quite a while, a client as well. I personally have a little over 4,400 co-owned GP units. I had somewhere just under 600 million. And then I'll introduce my partner, John Montero.
Yeah, thank you. Good to see so many familiar names on tonight's webinar. I appreciate everyone taking the time out of their busy nights to join us. I'm excited about this opportunity. I too have known Yoshi for many, many years. This is actually our third deal together in the Houston market. So we're very familiar with working with each other as well as the Houston market. A little bit about me. I am the founder of Texas Multifamily Investor Network, also co-founder of Revision Masters alongside Meryl. As of next week, we've got a big closing next week. I will be at 8,500 units, units in Texas, Texas only. That's where I focus all of my attention. I feel that Texas and Houston are the strongest markets in the country. And so I focus on multifamily in my backyard here. Based here in Frisco, Texas, economics major, undergraduate and MBA. I also do this full time and excited to present this opportunity with you all tonight. I'll hand it off to Ash if he's on, and otherwise to Yoshi.
Yeah, Ash is actually on the way to the conference. He's on the plane. So I'm going to just quickly introduce him. Ash is actually based out of Houston and actually not too far from the property, like 15 minutes from the Edison. So if something happened, emergency, he could be a good boots on the ground, taking care of that too. He has an impressive track record as well. He has 7,000 unit asset managed, and not only the multifamily, but he's in commercial and retail as well, and involved in more than 1 billion transaction. Of course, he's in the full-time real estate, commercial real estate investing, and also the operator. So I'm very happy that he's on our team for this deal. Amy and Hua.
Good evening, everyone. My name is Jaime Gonzalez, and next to me is my beautiful wife, Hua Wen. And we are based out of DFW, and most of our investments are actually in Houston, Texas. We have over 2,000 units as GPs, and we've invested in over 5,000 units also as LPs. We actually have a property 2.5 miles on Westheimer from where this particular asset is located, and that is performing much better than projected. And we are also company owners and therapeutic optometrists. We don't practice very much at all. We have many doctors that actually help us with our practices, and we do this full time. Thank you. Eleonora?
Hi, everyone. So glad to meet you. I'm very honored to be this powerful and rockstar team. I'm based on Dallas-Fort Worth, Texas. I own a 527 unit invested as a LP and GP, also own the 4 commercial deal. I'm devoted to full-time in the multi-family investing and operation, and also CRE broker, and also CCIM candidate in Dallas, Texas area. Kevin?
All right, good evening, everyone. Sometimes being the last one is also good because all the best has already been announced, right? We really have a rock star team right here. So my name is Calvin Wong. I'm also based out in Dallas. I have over 15 years in commercial real estate investing and experience. Previously, I was working with Goldman Sachs, and that's how I met Sam, our co-GP here. I've involved in more than 800 million in transactions. Also do syndicating in retail properties and investment and land. So Sam and Mohan, they started investing in multifamily a couple years back, and then they quickly, become expert by involving in different transactions, underwriting, and all that. So really excited to be a part of the team with Yoshi being the lead GP. And we really have a great team here. Of course, a very solid investment opportunity that we're going to share tonight.
Thank you, Calvin. So first of all, the executive summaries. So deal is in Houston, Texas, called the Edison, and the purchase price is 29.9 million. And the estimated equity raise for this one is 8.9 million. We have a good cost basis. Price per door is only 110,000 a door. Expected investors return is, we actually have 2 classes. For class A members, it's $150,000 minimum investments, and we give 10% preferred returns. And the class B members, it's 50,000 minimum investments and 7% preferred returns. Projected equity multiple is 1.95 or 95% total returns, which translated to a 19% annual returns. So 3 things we like about this deal is the location, story, and the cost basis, the price, right? So the property is in a great locations. As you guys probably know, the Houston growth is going towards the west. That's the main growth that Houston has, and all the way to the Katy's. And one of the main street from downtown to Katy is the Westheimer. It's a main street, and property is actually on the Westheimer, so it's a prestigious locations. Nearby businesses, including West Chase, Memorial, and Energy Couriers, and all these Class A retail centers are also nearby. Starbucks is just in front of it. You can walk to there in 30 seconds. And Trader Joe is also the walking distance. The Whole Foods is only a couple minutes drive. So location is very good. And the good story, right? It's an out-of-town owner, purchased it a few years back, self-managed, struggled, pandemic hits, and it get worse. So their equity partner gets tired of it. And after the pandemics, they put the professional professional property management back in 2021, and the performance improved, and they are kind of stabilized. Now occupancy is above 90%, but the equity is ready to get out. So that's the story. And also because of the good locations, the sub-markets is experiencing more than 20% rent growth last 6 months, as you can see in the slide. And this property haven't captured that rent growth because of the, because of the operation. So we can come in and capture those rent growth that they haven't captured. And also the, purchase price. We, like I mentioned, we'll purchase for $110,000, and the comps are going for $130,000 a door. So we are actually getting 20% less or 20% discounts already. Great cost basis because it's an off-market deal. We were able to negotiate back in the holiday season when the investment activity was slow. So we were able to secure a good price. So those 3 key points is the takeaway from the executive summary. So property overview, Hemi, it's gonna go over property overview, Hemi.
Thank you, Joshi. This property was built in 1978. As we were touring this property, it shows more like a mid 1980s. It is 272 units. The physical occupancy is 93%. It is pre-leased at 95%. The average unit size is 768 square feet. It is brick and hardy plank siding. It is individually metered. It has individual HVACs, sub-metered, and rubs. We will improve on the rubs for this particular asset. And the breakdown from 1 bedroom to 2 bedroom, it is 74% 1 bed. And it has never been flooded, never. Next slide, please. And here is showing you a nice range of square footage for all renters. It starts off at 525 square feet and it goes all the way up to 110 square feet. All the 2-bedroom units have a townhome feel since the 2nd bedroom is actually upstairs. Next slide, please. These are some of the images of the amenities. So we realize that as we take a look at assets, if we improve the amenities, that leads to better quality renter. And with these amenities, it has a really nice pergola already implemented. It has 2 swimming pools on the property. And this particular image here, it looks pretty bland. We're gonna greatly improve on the swimming pool. It has brick grilling stations. It has package lockers. It has a really nice business center with iMac computers. The fitness center is for strength training and also for cardio. We are a pet-friendly community, so we love people and renters that have a pet because that can increase our other income. And we are expected to plan a lot of social community events per year. And our carports currently have a $35 per month mark currently, and we will be increasing that for other income. And the extended patios and balconies you can see in that picture, and also the package lockers. And next image, please. And this is a couple of images on the right of the leasing center. It looks more rustic feel, a lot of brown in, and we're gonna be fully upgrading this leasing center, more modern, more sleek feel, more inviting feel to this center here. Next slide, please. The bottom images are more classic units that we currently have. And for the classic units, what we're thinking about doing is upgrading them to premium units, stainless steel. Some of the wood, the faux wood already looks excellent, but a lot of the appliances we're going to be upgrading. As you can see towards the top, those are partially renovated units, but we're going to go a step up from this particular partially upgrade unit. And next, Eleonora is going to take us to some of the improvements, some of the images that we're going to be implementing. Eleonora?
Yes. Yeah, this is the pond part that we wanted to upgrading as the property condition is really good from quality construction from 80s already. So we just touch up as low cost and high impact. Just change the stainless steel on the unit and a hard surface countertop, preferably granite or the quartz. And then cabinet surface, we want to change the front door and then the nice hardware. And then tile will be going to subway tile. It is a timeless piece and it goes long way. And also the upgrading the lighting and change the pendant lights. Also the new vinyl flank floors. So interior upgrading unit is the desirably the new tenants. And we have a sample unit image on the center. And also the amenity enhancement, we're including the resort style pool. And even though we have a more than typical apartment unit kind of a pool, but we're going to upgrading as a palm tree and a professional landscape, also the reading office, and also the business center, including the exterior touch-up. If I'm moving on to next slides, this is just a Photoshop quick tweak, but we just want to presenting you as an idea. And then the Photoshop image will not be just this, the actual beauty of the outcome, but currently we have a 2018, that design is a very rustic and kind of a man cave, but we wanted to upgrading to high-end looking, also more desirable to white collar professional, and also upscaling or the more inviting, and just change the color and replace the lighting to be a more statement pieces, then we can achieve the cost-effective look without heavy lifting construction or rehab. Also the leasing office, the refreshing center has to be inviting and all the declutter, and we want it to be clean and tidy, in just providing a storage and change the color to be look more like high-end looking. Next, please. And also the exterior touch-up. There is a 4 different color incorporated in this apartment. There is a yellow and green and also the red. And we wanna remove all the strong lime color, which is no more desirable to nowadays. And also the existing the entry structure is kind of a small that we want to expand it to make it bigger, and look the cover with the material with the oil rub metal with a stainless steel signage to very upscale and sophisticated looking, and also will be very noticeable from a potential tenant who might be drive by. Also, the exterior touch-up with the painting, the color is very tricky. So we know that this color is more, because of this color will look very fancy. Also the modern looking. So we want to cover the orange color brick to the cream white almond, and also the match with the existing material very cohesively. And some of the neutral color will be kept, and cost effectively, we were just replacing the color that will be harsh and outdating. Alrighty, if we're moving on to the CapEx. So include all this planning, it is more than realistically achievable within a budget 2.1 million. Amenity enhancement will be 200,000, and we will focusing on the interior design part, the premium unit for 200 unit for upgrading 1.6 million. Also, we have a reserving for the backup for contingency and plumbing for 300,000. Now I'm handing it over to the John.
Thank you, Eleonora. just want to take a second and talk about the market overview. The first slide here is showing the Houston market and the solid fundamentals around the population and job growth that this market continues to see since 2020 through 2025. You'll see that Houston, from a population growth standpoint, is number one in the country, and from an employment growth perspective, number two in the country behind Dallas. We really focus on markets that have this huge demand of people and jobs moving here, because that really allows us to control the asset where our occupancy levels will continue to remain high, and we're able to continue to drive rents in the future. Next slide, please. So this is the other side of the supply and demand equation. On the previous slide was demand with regards to jobs and population. Here it shows that the supply within the Houston market is extremely short, has a huge shortfall of housing units, here showing a negative 23,000 units. For those that live in Texas or have been to Texas, you will know that this state is extremely, and Houston in particular, extremely pro-growth in terms of housing. There's a lot of housing being built, single-family homes, townhomes, apartments. But what this slide shows, and what we've continued to see over the past decade, and I think we'll continue to see over the next 5 to 10 years, is that there will be a continued housing shortage, chronic housing shortage in the Houston market, which again will allow us to be able to push rents and maintain high occupancy levels to be able to drive our net operating income plans. So the next slide, please, will be talking about the submarket, and I'm going to hand this off to my partner, Merrill, to go over the West Houston area.
Thanks, John. This is just kind of following along with what John had just talked about as far as Houston MSA and the imbalance between growth and availability, which is an ideal place for apartment investors to look for. So we're just going to drill down a little bit to the area surrounding the Edison, as you can see on this map. It's very strategically located between the Energy Corridor, West Chase District, and kind of the central business district area. There are over 400,000 people within this kind of 7-8 mile radius, and there's not a whole lot of opportunity for new construction to go up, especially near the Edison. So within about 10 minutes, people that live there can be, right there at their job. There's major shopping. You'll see on some of the next slides. It's an ideal location for multifamily. And this is kind of drilling down, as you can see, kind of the major and pretty consistent big boxes that are around the Edison. Quite honestly, they're within walking distance of the Edison. And then you see the Energy Corridor up to the top of the map, labeled number 1. Some of the highest paid employees are there. And so it really helps with living arrangements around that area. Median income is much higher than most of the other areas. You've also got the Memorial District with a lot of healthcare surrounding it, and you've got the Western District down on the bottom right corner. So the average age in this area is a little less than 35. You've got a lot of young working people, a lot of white collar jobs. Homes in this area are averaging just under 400,000. Many of you that are on the East and West Coast, that sounds pretty low, but for areas like Houston and DFW in the city, those are pretty good averages. And again, the average household income is just under 90 grand. So great location, great walking distance to many of the employers, and great walking distance to all of the retail. I mean, they literally don't have to leave the area. Next slide. And then just kind of focusing in a little more on the submarkets. You've got the healthcare section, which has 6 of the largest healthcare centers pretty much in Texas, and Memorial Hermann Hospital, Memorial City, and Methodist Hospital. And then as far as retailers, you've got basically every major retailer in Town and Country Village and Memorial City Village, City Mall, excuse me, which are pretty much within walking distance or a short 5-minute ride from the asset. And then off to the right, you're not very far from downtown, or what we call the uptown area of Houston, and the Galleria, which again is very high dollar, lots of shopping, lots of jobs being housed there. So it's a great opportunity to have an asset so close to this area. The next slide. Again, just a little more of what we were talking about, the Memorial District, where a lot of the healthcare area is. They also have large corporations that have housed there, Air Liquid, Cobalt Center, lots of great things going on near the downtown area. And John and I both mentioned earlier that we have quite a few assets in Houston. This is an excellent location for an asset at the right price. Next slide. Then I will pass the baton on about the business plan.
Thank you, Meryl. So from this point, I'm going to present rest of the presentations, the business plan. So as I mentioned in the executive summaries, it's operationally distressed assets. The current owner struggled and finally stabilized it. But the good thing is that the quality of the property is good, and they spend more than 1 million capex into new leasing office, fitness centers, Amazon lockers, stuff like that. So we can come in and do the cosmetic touch-ups and make it look and clean and sleek looks to cater to the demographics in the submarkets. And the improvements is, of course, you come in and spend 1.6 million for the interior renovations to bring up to the market rents. And we'll also do the enhanced amenities like Eleonora mentioned. We're going to freshen up the leasing office, pool area, and potentially install like technology package. It's still in the considerations, but some of the value add that we are considering right now. And then stabilize the asset and capture the rent growth, right? So we're going to use the asset living as a property management. They are based in Houston, and they manage more than 100,000 units. And within Houston, they have more than 20,000 units. Of course, they're number one in the markets. And I have been using asset living in different assets. And our core GP has been using asset living for different assets in Houston. Everybody speak highly about them. So we are very confident that they're going to do a great job to bring it to the next level. And exit strategy is 3 to 5 years. This is the bridge loan. So we wanted to exit less than 5 years. That's the business plan. And if market is not enough, is in our favor, we also have an option to refi to keep it a little bit longer if needed. But the main strategy is to get out in 3 to 5 years and optional to refi. Again, industry partners, the asset living is our property management. And all these partners, I have been personally working with all these guys in many deals in the past, and they're working great. So, I'm excited to have these guys on board as a team. And again, we're going to bring it to the next level with these, these vendors too. So financial analysis. So first of all, rent comps. As I mentioned early, the submarkets was experiencing like more than 20% rent growth last 6 months because of the submarket, like Meryl went over, is a very strong location. So if you, as you can see, the Camden Whispering Oaks, it's more like a class A minus deals in the same submarket. So we can compare what the class A is doing. And also Ashford Cove is the class B deals built in 78. So it's a very similar vintage to the Edison's. As you can see, they're getting more than $1,000 for the 1-bedroom, and the Edison is now we're getting $950. So we're going to increase about $100 to catch up to the markets. For the 2 bedrooms, Ashford Cove is getting $1,600. And Edison is very shy right now. It's only $1,100. So we're gonna increase, 200 bump and bring up to $1,400. So point here is, first of all, Class A deals are getting, $300-400 higher than Class B deals. Being a Class B deals, we can offer the affordable housing. If the tenant doesn't want to spend Class A rents, they can always come to us and save a couple $100 staying our property. So we are in a good position to capture all this demand. And we are not trying to beat everybody in top of the market, right? We are just trying to playing a catch up. We try to catch up to the property like Ashford, and we are still shy from Ashford, and there's a high chance that we can actually exceed Ashford rent, right? So rent comps are very realistic and also the conservative. Sales comps, like I mentioned, we were able to negotiate back in holiday season, off-market deal. We were able to secure at the good cost basis, 20% discounts basically. Comps are going $133,000 a door. I know one of the deal just got on the contract a month ago. It's just 5 minutes north from here, and the location is a lot weaker than us, and it's like 80s vintage for $130 a door. So comps are solid, and I'm very excited actually getting to this deal at this cost basis. It's like a business 101, right? When you make money, when you buy. So this is really this type of the deal. So acquisition summaries, I already went over that. And the financial summaries, it's going to be a bridge loans. It's 24.6 million. And the term is 3 years and 2 1-year extensions. So total of 5-year term. And it's interest only throughout the term. Right now, loan to value is 76%. We actually got a soft quoted higher than this, up to 78%. But we use the conservative numbers just to make sure that we have a wiggle room here. If we can get 78% as soft quoted indicated, then the projected return is going to go up. But we don't want to use that. We just want to be conservative and use that little lower number than what it is. So interest rate is 3.7% floater. They require a cap, so we're going to buy a cap. So that kind of give us a peace of mind for the floating finance. And the prepayment is just a very low 0.25%. Sources and uses, as you can see, all in is about 33.5 million. Sources, just two sources. Senior debt is the bridge loan, and equity is here, the investors. And the uses, the purchase price again, 29.9. CapEx is 2.1, and the closing cost and operation comes to 33.5 million. So underwriting, we use very conservative underwrites. So we use 2% income growth throughout the holding period. You've probably seen a lot of deals out there using like 5% for the first or second year and 3% on the third year and 2.5 rest of the years or something like that. We use 2%, even though sub-markets experiencing 20% rent growth last 6 months, we are still using 2%. So it's a super conservative numbers, and pro forma year one income is only 5% growth from current T3, which is very conservative, and there's a high chance that we can exceed that number. And this is a stress test. So break-even point is 35% on the up right corner. So even during the pandemic, I haven't seen any of my deals got below 35% economic vacancy. So we have a good buffer there. 35% is a break-even in terms of economic vacancy, and ROI as it is, it's 116% gross return as a deal. And then there's a split between investor and the GP team. So investors get like about 95% returns. But if we can get the 2.5% annual rent growth and be able to get out at the 4.5% reversion cap rate, then return goes up to 180%, as you can see. And for the downside, if we have zero rent growth for next 5 years, which is like hard to believe it's going to happen, but zero rent growth and reversion cap of 5.75, which is ridiculously high. I have a hard time. It will happen in the next 5 years. It's going to go down, but I think it's just a trend is keep going down, right? Not going to go up. But even if that happens, deals still make a returns, 50% returns. So which is very good. And the asset value is the same story. Our exit price is 39 million. But if rent growth is 2.5 and the reversion cap become 4.5%, which is the markets, and really have a high chance that we can sell it at the 4.5% reversion cap, then it's going to jump up to 45 million sales price. And even if we don't have rent growth or reversion cap shoot up in the 5.75, we are still holding asset value. That's the beauty of getting in at the good cost basis. So cost seg study, of course, we're going to do cost seg study and do the bonus depreciations as a property. You should have about 80% depreciations for the first year. And the deal structures, the property management fees, 3%, asset management fee is 2%, acquisition is 2%. In case if we have to refi, there's a capital event fee of 1%, but we don't charge disposition fee. And the split is 30-70. 30 goes to GP, 70 goes to the LP, the investors. I can explain a little bit more detail about the split and the returns for the investors. So here's the investment opportunities. So as I mentioned, there's two classes. One is the class A, and the minimum investment is $150,000. And of course, they are qualified for bonus depreciations, and the distribution is happening every quarter. So we're gonna give 10% preferred return for class A members, and average annual return is gonna be 19%, and equity multiple is 1.95 or 95% total returns. So 10% preferred returns, that means that class A member has a first position of the distribution. So they get the 10% of the return first from before anybody else gets returns. And then class B gets preferred returns. And when we satisfy class A and the class B preferred return, that's when split happens. Everything beyond the preferred returns, it's going to be 70-30 split. And then there's a threshold. So anything above 18% IRR, then it's going to become 60-40 split. So class B members, as I mentioned, it's 50,000 minimum, and they get 7% preferred returns. And they're going to have a second position. So class A member gets paid first for their 10% preferred, and the class B members get their 7% preferred returns. And until we satisfy, GP team not going to take any compensations. So we put investors up front, and that's our motivation to meet or exceed our projections. So this is just show the actual dollar amounts if you invest into class A and the class B. For instance, if you invest into class A for $300,000, from the cash flow returns and the preferred return catch up, you get 124,000 returns throughout the holding period. That's about 41% returns from the initial investments, and then you get 151,000 from the capital gain, which is about 50% returns. So total returns going to be 92%. So you get $276,000 total returns, including the initial investment, you get $576,000. And if you look at the Class B members, it's 50,000 investments from the cash flow and the 7% preferred catch up. It's 41% returns from the cash flow. It's about $20,000, and the equity returns is about 49, a little less than 50%. So that's almost 25,000. So total ROI for Class B members is about $45,000, including initial investment is 95,000. So this is kind of like a visualize how the capital stack looks like. Of course, there's a bridge loan. That's the senior debt that we have to make a payment. But right after that, Class A members have 10% preferred return as the first position of the distributions. And the Class B members get second position of the distributions. And once we satisfy Class A and B, anything above that is going to be 70-30 split. So investors get 70% and the GPs get 30% up to 18% IRR. And it become 40-60. So this is the subscription process. After this webinar tomorrow afternoon, we're gonna email the subscription link to the subscription docs. It's called the cash flow portal. So if you don't have the accounts, you click on it, you create accounts, and click on the Invest Now button. Now you can get into the DocuSign like electronic forms and a signature page. So you can fill up the forms online and then click submit. Then that information comes back to us. So we're gonna review, make sure everything is correct. Then we're gonna send you we're gonna approve and then send you the wiring instructions. And then please wire within 5 business days once you receive the wiring instructions. And as soon as we receive the fund, that will complete the subscription process. So if you fill up the form and submit, that doesn't mean that you completed the subscription process. You complete the subscription process when you wire the funds and we receive the funds, and you get the email from us that we received the funds. We had 160 plus people attending on this webinar. Actually, more than 300 people registered on the webinar. We have a high interest on this deal. So we are expected to be fully funded very quickly, probably within a week. So if you are interested and wanting to invest, we encourage you guys to act quickly and submit the docs as soon as you receive the email. And wire the funds. Don't wait 5 business days, but wire the funds as soon as you can. So that's the subscription process. And acquisition timelines, again, due diligence ends last week, and today is the webinar date, January 18th. And then capital raise start from actually tomorrow afternoon. You will see the email about 5 p.m. Central Time. So look for the emails for the subscription link about 5 Central Time p.m. tomorrow afternoon. And again, we have a high interest, so expect to go fast. Please make sure to act quickly if you are interested. And the capital raise ends February 8th, but we are expecting a lot faster than this. And the scheduled closing date is March 8th, or before or on March 8th. So that is the end of the presentations. And now we'd like to open questions, and we try to answer all these questions as much as we can. So Calvin, if you wanna kind of find the questions and read out so that we can answer, all the core GPs can answer the questions.
Absolutely. So obviously, I've been collecting all the questions and try to answer as we speak. One of the questions came in as, is the property in the flood zone?
It's not in the flood zone. So as a GP, we are looking for the deals in Houston market. If it's not the flood zone, we don't buy the deal. And if we got flooded in Harvey, even though if it's not in the flood zone, we don't buy the deal. So these are the two criteria we have. It's not in the flood zone. It didn't flood in Harvey. Those are the two criteria we have.
Okay. Do we have the crime statistics for that immediate area?
We can send that to you. I don't have it handy right now. I don't think it. I mean, it's a Class A type of neighborhood and the Class B buildings. So I don't expect to have like a high crime, but I don't have the specific numbers. I've
Yeah.
seen it, but I don't have the specific numbers. It's low. It's not high, I would say, but I can send the exact numbers if needed.
Yeah, so for those that who are not familiar with Houston, so this asset, Edison apartment, is on Westheimer. So it's very similar to like Preston Road in Dallas. So if you are from Dallas, it's a very busy street, and the surrounding retailers are national brand name. So HEB, Trader's Joe, Whole Foods. It's like close by to the assets, and as you can see, you know, a lot of time with this retailers, they only want to open in the area that is, you know, rather, you know, safe and whatnot. So, you know, of course, everyone can do their own due diligence. You can just plug in the address and just look at the surrounding. So, personally, I'm not too concerned about you know, the statistics on crime just because what the location is. And then the next question is how many KPs are in the team?
We have 3 KPs, myself, John, and Meryl.
Okay. And then as far as the renovation, are we doing, because we are upgrading the interior, you know, 200 plus units, is it like 10 per month, or what's the
So our
process?
plan is to renovate almost 100% of the units in 24 months. Divided by 24 is about, yeah, 10, like 5 to 10 units every month. So we're not going to evict people just to renovate the units. We're going to maintain the occupancy to low to mid 90%. And when it becomes available, that's when we're going to renovate. So whenever tenant goes out, we renovate the units, and that happens, you know, 5 to 10 units every month. So at the beginning, I think we have close to 20 units that sits vacant. So we can start 20 units at a time. But at that point, after that, it's going to be 5 to 10 units per month.
Okay. So one of the comments from our audience attendees, Serena Trinidad, that she actually went to the apartment in December and, you know, kind of pretended to be a renter and walk around the property, talk to the manager. Her comment was, "It's a great and safe location."
Oh, thank you.
So that's thank you
We
very
did
much
that
for that
too.
feedback. You know, again, everyone, you know, can you know, if you just do like reviews in Google, and you can kind of get similar feedback as well. Is there a water treatment system? I'm not sure I understand that question. Do they have a water?
Yeah, it's a city water supplied to the property, and we don't have any additional water treatments after city water supplies.
Okay.
And we do have a treatment, right, for the pool, but not for the domestic supply.
So how much is available for Class A and for Class B? Is there a
We don't
Is
we
there a
don't have a
limit?
limit. We don't have a limit on both of them. As soon as we raise up 8.9 million, that's when we close. And I would assume like a little bit more than half will be class A, and then rest will be class B. But we don't have the set limit on that one. We just have a limit overall 8.9 million.
Okay.
And by the way, I just want to say about this. And then other co-GPs, feel free to jump in if you have answers or if you have comments. But I just want to say one thing is that, as soon as we get 8.9 million and fully funded, we're gonna kind of, inform you guys that, hey, it's fully funded. And at that point, you guys can be on the waiting list. And in case somebody backs out or something happened, then we can bring a few more people in. So as soon as we receive the funds, that's the completion of the subscriptions. And then once we hit the 8.9, we will close it and then put on the waiting list.
As far as the distribution, is it quarterly distribution?
Yes, it's gonna be quarterly, but the first 3 months is the transition period. We're gonna take over. There's a lot of things happening. The property management will settle in, and financial is not stabilized for first few months. So expect your distribution maybe like 6 months from the closing, and at that point it's gonna be quarterly distributions.
The bonus depreciation, is it only applicable to Class A?
It's gonna be both Class A and Class B members.
How big is the land?
Land is
Property.
8 to 9 acres. I can't remember exactly. I think it was 8.7 acres. Yeah, a little less than 10 acres. It's a good size land in the prime locations of Houston. So land value is a little bit higher than normal.
Okay. What is the debt service coverage ratio?
It's well over one. Debt coverage ratio. It's a bridge lending, so it's. Let me see. I don't have the spreadsheets right now. I can get back to you on that one.
It will be well over 1.25 because that's pretty much the underwriting
Yeah,
guideline.
1.25 in a year 3, I believe, because it's a bridge lending and it's operationally distressed property. That's why we can get it at the good cost basis. So this is a value add deal. So debt coverage ratio is not as high as the stabilized yield play deal, but we'll get there quickly. And then it's well over 1.25 in the second year and third year.
So another question, can you please elaborate on the exit strategy? What are you trying to attain before deciding an exit?
So primary goal is to get out in 3 to 5 years before loan term ends. But in case if there's another pandemics or economics downturns and the timing is not in our favor, then that's the time we will consider refi and hold for next few more years until economy and the markets recover, then exit. But the first option is to get out in 3 to 5 years. If market continues to be, what it is today.
So what is the current occupancy? So I think you mentioned on the slide, it's 90.
Yeah, 93% and pre-leased 94 to 95. So occupancy is there now after they place the professional third-party property management. That happens probably 8 months ago or 9 months ago. And they're busy just bring up the occupancy to 90s. It was operationally distressed property. That's why we were able to capture this, secure this deal at the very good cost basis, meaning good price, discounted price.
And then do you happen to know on top of your head how many parking spaces?
Parking spaces, it was like one per bedroom. So 300, I don't have the exact, but one per bedroom. So so about like 350 to 360 spots.
Okay.
Yeah.
So if a unit is continuously occupied by a tenant, would that unit never get updated?
Yes, so we don't force them to go out unless they don't pay the rent or anything like that. Then if they don't pay the rent, we have to evict and we got new tenants in. So average standard for this type of property is about 50% renewal ratio. And if it's stabilized property and a lot of tenants are long-term tenants, then it goes up to 60 or 65%. For this deal, we are catered to young white professionals in the in the submarkets. I would expect to have about 50, a little bit more than 50% renewal ratio. That means 45 to 50% of the tenants will go out next 12 months.
Another question is, if the market grows really well, then projected, does that mean we will exit early?
There's a potential, yes. Yes, less than 3 it's a potential to exit early. If we can meet or exceed the projected returns in shorter period of time, we'll exit.
Are we doing anything else to add, additional income? I know you mentioned about like the amenities, right? Having the pad and things like that. Anything else that?
Yeah, so in submarket, and this property is already have a washer and dryer connections and actual units in the unit, like 100% of the units is already have that. They already have carport, Amazon lockers. One thing we could potentially do is the technology package. So we can have a main Wi-Fi connection to the property, and then we charge tenants technology package fee or amenity fee. That could be an option that we're going to explore to make sure that it's durable. But again, they're getting like more than $200 less than market rent. So our primary focus moving in and going in is to bring the rent to the market with the amenities that we have already. Of course, we're gonna improve the operation, right? So for the carports and the reserve parking, they have like 35 spots for the carport, but only like 12 or 13 leased. And it should be full and it should be on the waiting list. So those are the things that we're going to do to make sure that we are fully capturing the potential.
Which sponsor live in Houston? Do we have
Ash,
good?
yeah, Ash Shah, he lives 15 minutes from the property. He lives just north of that property.
Yeah, and he owns about 7,000 units.
7,000 units,
Okay.
and also retails and office buildings as well.
Yep.
He's
So
a
we have
big
boots on the ground. We have,
yeah,
really experienced.
and he has an
con-
operation team. So not only him, right? So we have multiple people in Houston, boots on the ground.
Okay. Yeah, we really have a lot of great questions. And then one of another question that just came in is, what happens if there's a market turn?
Mhm.
Of course, we always project if there's, what's the worst case scenario. So maybe kind of elaborate a little bit on that.
Yeah, so a good beauty of the real estate investment is we can time the markets, right? So if market turn, have the downturns, we'll time it so that we can refi and keep it longer, and we time it and we exit when the time is right.
What is our cash flow? Are we cash flowing from day zero? That's one.
Yeah, it's a cash flow deal, even though it's not as high as yield or the stabilized assets. It is cash flowing.
Okay. What is the economic vacancy?
Economic right now, I would say right around 90%. Could be a little bit shy of 90%, right around 90%.
Sure.
Or term, like its actual meaning of economic vacancy, like just a terminology, or
I think
numbers.
they are looking for like the numbers.
Okay.
So if the economic occupancy is not 90%, so that's the vacancy will be 10%. Let's see. Thank you, Linda. Linda mentioned that it looks like a great deal, great job. So I think we pretty much cover a lot of questions.
Yeah.
Some of it, for example, like text questions, like, what is the implication to your income? And that's really case by case because everyone have different, income level and tax bracket. So this is a, a passive investment, right? So Yoshi, you can elaborate more on that. It's with the depreciation, it will be helpful to offset your income. But yeah, it's just case by case based on what's your income level in regards to the tax. But overall, it's a solid, great performing assets. Location is it's one of the best location on Westheimer. Okay. How are we doing on time, guys?
Right now, 8:08, so we are a little bit over 1 hour, including the questions. So I think it was good. Oh,
Okay.
more questions seems like, I don't know. Oh, thank you. Yeah, it's not questions. Thank you. Yeah.
Okay. So are they gonna get a presentation slide or recording or
Yes. So presentation slide is part of PPM, and which is on the cash flow portal that you guys gonna create accounts and log in. And also we will share the link to the recorded webinar in case if you want to see again, or you know, your spouse or your partner wants to see, or whatever, it's available.
great.
Yoshi, could I say a couple words before we wrap
Sure,
up?
sure, please,
Yeah,
please.
this is John Montero again. Again, I thank everybody for spending the evening with us. I've been doing real estate for over 25 years. Like I said earlier, 8,500 units, all in Texas, with $1 billion of assets under management with my other partners and investors. And one of the things that I've really learned is besides obviously working with the right team, you've got to buy right and you've got to operate right. And we feel like we've got a phenomenal cost basis going in at $110,000 a door. In this market, we're probably already at $130,000 to $150,000 a door. So we've already have some built-in equity going into the deal. And then on the operate right component, all of the co-GPs on this team are extremely experienced, have been doing this a very, very long time. And with our partnership with Asset Living, who I have multiple assets that they also manage very, very well. We're excited about that partnership as well. So you buy it right, you operate right, and I think the market is really going to do good things for us. The last thing I'll say is I look at a lot of underwriting, and I would say that the underwriting that was presented earlier by Yoshi, his numbers are extremely conservative. We want to under-promise and over-deliver, but I feel really strongly that the numbers in the underwriting model are extremely achievable with a lot of upside. But you know, I think time will tell. But I feel good about the underwriting model. So again, I appreciate everybody's time, and I'll just hand it back off to Yoshi.
Thank you, John. So any other questions? Kelvin, do you see any other questions, or we just gonna end this presentations?
I think that's it, other than
Okay.
great. Yep.
All right.
That's
Again, you know, like John said, you know, I strongly believe that this deal has a lot of great components like cost basis, the operations, the markets, the locations, all the checks boxes are checked. So I really love this deal and I'm very excited about this deal. So hopefully we can invest together and make good things happen. Thank you guys for your time to attend this webinar. I know it's evening time and you guys are busy, you know, with the businesses and families, and that means a lot to us for you guys to, you know, have time and jump on the call. So really appreciate it, and I hope to talk to you soon, guys.
Thank you, everybody.
Thank
Thank
you,
you,
guys.
everybody.
Thank you.
Yeah.
Good
Thank you, guys.
night.
Bye.
Good
Good night.